that people have been repeating that same line for the last 3 years, and with one small exception, they've been wrong. The market, I think, is going to continue to grind higher. We're now on the off ramp from earnings season, and earnings season here in the United States was actually a little bit better than expected. Admittedly, expectations were pretty dreary, but we managed to do better than those expectations. And now, unless there's some sort of either geopolitical news or news out of the Federal Reserve, I don't see a catalyst to take us lower. And people who've been rooting for some sort of correction for the past 3 years, I think, are going to be wrong for much of this year.
Well, maybe the Fed doesn't have to take any action, Scott, because the market's already doing the work for them.
You know, to a certain degree, but I think the Fed is actually anxious to start normalizing rates, and that's the issue here. It's not just that they want to raise rates, it's that they need to normalize rates. And I think the Federal Reserve is anxious to get that started. I now think that the first rate increase will be in September, but the date of that increase is not actually particularly important. I think much more important is the pace at which they continue to raise rates, and while it's not going to do our viewers much good, it's important to remember that Janet Yellen will speak at about midday on Friday here in the United States.
Okay, let's talk about the retail space for the moment, Scott, because I noticed in your research, you said that there is one part of the economy that's looking a little bit scary right now for the short term, but this is good for the long term. Now, we're talking about the fact that these retailers, and the big names too, like Walmart, are coming in with results that are disappointing investors and disappointing the street.
Oh, it was horrible for Walmart investors today, and it's been bad for retail investors in general for the last several days. But why is this short-term bad but long-term good? Well, it's obvious why it's short-term bad, because Walmart just got crushed today and brought retailers down with it. But as Kayla pointed out a few minutes ago, what this means is that the money that American consumers are saving at the gas pump, they are not running out and spending. They are saving it, or they are paying down debt, and over the long term, that is going to be great for the U.S. economy. May not be great for retailers for the next couple of months, but over the long term, having Americans save more money and spend less money is a great thing.
So that's a little bit worrying to me, though. I mean, if you put together the two factors of the Fed and the U.S. consumer, strength of the dollar index, a handicap to multinationals, and now you're saying that, the consumer's not as robust as you thought it was, and people were saying that maybe you concentrate on domestic-centric companies. That leaves what in terms of equity investors if you wanted to focus on the U.S. markets?
I think financials are going to do much better, given that net interest margin, once interest rates start to normalize, net interest margin for the big financials should increase profoundly, and so they are going to do very well. They seem to lurch from one crisis to another, that is, one malfeasance to another. You asked the question, is Wall Street not doing everything it might to stay on the straight and narrow? The banks don't want their traders to break the law. The banks don't want their traders to do the wrong thing. In the long run, they can't make enough money breaking the law or violating confidence to make up for these multi-billion-dollar fines that they end up paying. And I think the banks are really incented to stop this sort of action. But in the shorter term, net interest margin will help them. And once the Fed starts to increase interest rates or normalize interest rates, then trading volume will also increase and trading revenue will increase for the big banks.